Welcome to the ResearchTrade tutorial on trading the evidence. In this video, we will explore using ResearchTrade.com trends along with simple indicators to improve trading results. We currently research over 140 stocks for earnings and seasonal trends. Each of the trends we publish on the site have reoccurred at least 80% of the time over the last 5 to 20 years. 80% is a high number, but it's not high enough to trade based on the earnings or seasonal trends alone. We should trade the trends based on the current chart evidence. There are many good technical indicators available to use to examine the chart evidence. In this video, we will demonstrate using simple moving averages and Bollinger Bands. Let's take a look at the stock, STLD, Steel Dynamics. This is a recently completed 4-week seasonal trend. During the time frame of December 19th through January 17th, STLD has rallied 14 of the last 15 years. The average return is over 7%, and the median return is over 8%, a very powerful trend. This is the chart of the 2011 trend. On the chart, the red and the green lines are simple short-term moving averages, while the blue lines are the Bollinger Bands, which represent potential support and resistance levels. The date range of the seasonal trend is highlighted in yellow. We see that the stock had a nice pullback prior to the start of the trend. On December 20th, the moving average lines crossed going up, which indicates a trading entry. On December 29th and 30th, the moving average lines briefly crossed again, which could signal an exit from the trade with a conservative 2 to 3% gain. If we stay in the trade, the stock takes off in January and rises about 20%. Let's take a look at past years for the same trend. In 2007, we get an entry on December 20th when the lines cross going up. The stock rises quickly to the top of the Bollinger Band over the next 4 to 5 days. Here, the stock struggles with the Bollinger Band resistance, which would signal a trade exit with a nice profit. 2008 was the only year this 4-week seasonal trend was broken over the last 15 years. On the chart, we see the stock had a nice rally before the trend date range. If we traded solely on the seasonal date range, we would have seen the stock drop over 9% in that time frame. However, we should trade the chart evidence. When we use the moving averages to get a good entry, we can still make a profit using this trend. Using the moving average lines, we get an entry on December 30th as they cross going up. The stock then rose the next 4 days towards the Bollinger Band resistance. We could then exit with a profit on January 6th, January 7th, January 8th, or at the latest January 9th when the moving average lines crossed headed down. This demonstrates the power of using the trends plus simple chart indicators. Even in a year when the actual seasonal trend is broken, we still make a profit. In 2009, the crossing of the moving average lines gives us an entry on December 22nd. The stock rises for a couple of days and then turns down. On December 29th, the lines cross going down, signaling a trade exit for a break-even trade. On January 5th, the lines cross going up again, giving another entry. The stock has big gains over the next 3 days. As the stock struggles with the Bollinger Band resistance, we should exit the trade on January 8th or January 11th with a great profit. In 2010, we probably wouldn't have traded this trend. The lines crossed on December 29th, and the stock actually makes a pretty good run through January 13th. But the December 29th entry wasn't ideal because the stock was close to potential resistance at the top Bollinger Band, which limits the expected gain of the trade.